Hi and Assalamualaikum. My name is AMALINA binti AMIN and my matrix number is F1015. Today, I want to present my part which is the question 5.1.1 and question 5.1.2. Okay, first, what is a financial stability? Financial stability refers to a condition where the financial system can function effectively even during periods of stress. This means the system can allocate resources efficiently, manage risk appropriately, and ensure a proper price discovery without expensive excessive volatility. In a stable financial system, institutions can fulfill their contractual obligations without distraction, and the system can absorb shock rather than amplify them. Why bank needs the regulation? Bank require regulation for the several critical reasons. First, banks play a vital role in the payment system, facilitate economic activity throughout the economy. Any disruption to banking service can have immediate and widespread negative impact. Second, banks create a credit and manage the public deposit, placing them at the head of monetary policy transmission. This special role comes with a unique responsibility. Third, banks are highly interconnected, create a network where the problem at one institution can quickly spread to others. This interconnectedness creates a systemic risk that individual banks have a little incentive to manage on their own. Fourth, there is significant information asymmetry between banks and their customers. Depositors cannot easily access a bank risk profile, create a need for external regulation to protect consumers. And the last point is the existence of deposit insurance and the implicit government to support create moral hazard. Without the proper regulation, banks might take a sensitive risk knowing they have a safety net. Next is about bank financial structure. Banks have a unique financial structure compared to other business. Their balance sheet typically consists of two sides. First side is an asset side and the second side is a liability and equity side. On the asset side, we have a loan to individual and business, security holding, cash reserve, and fixed asset. On the liability and equity side, first for the liability, we have a customer deposit, and for the equity side, which is we have a shareholder capital, variable reserves, and retained earnings. What makes the bank different from the others? This is because they operate with much more debt relative to equity than most business. What happens when banks face losses? When banks lose money, first, these losses can reduce the value of the bank asset. The losses are mainly absorbed by the bank on capital. If losses are big enough, the bank might not have enough money to pay everyone. People might panic and try to withdraw their money all at once. This can create a bank run where the bank runs out of cash. Banks face three main risks. First, they use a short-term deposit to fund long-term loans. Second, they operate with a very little of debt on money compared to what they owe. And the third one is they are connected to many other banks, so the problem can spread quickly. So the conclusion based on the two questions that I present, first is understanding the financial stability and bank regulation help us see why we need the rule for banks. Banks have a special role in our economy, and their unique structure make them vulnerable to certain risks. The proper regulation can help keep our financial system stable and prevent economic issues.
The Basel framework ensures that banks manage risk effectively and hold enough capital to absorb losses. This helps protect depositors and maintain financial stability. Basel I, introduced in 1918, focused on credit risk. It requires banks to maintain at least 8% capital against the risk-weighted asset. Risk weight range from 0% for government security to 100% for unsecured loans. Basel II, launched in 2004, introduced three pillars: First, minimum capital requirement covering credit, market, and operational risk. Second, supervisory review to ensure bank have sound risk management. Third, market discipline through transparency and disclose. It offer different approach for calculating risk like standardized and internal rating based model. Basel III was developed after the 2008 financial crisis. It aimed to improve bank resilience by increased capital quality, introducing ration, and strengthening liquidity rules through LCR and NSFR. And finally, Basel IV rules on Basel III and its standard risk calculation and limit how much material model can reduce capital requirement and output flow was introduced to ensure a minimum level of capital is maintained. In conclusion, the Basel framework continued to evolve to ensure banks remain strong, trustworthy, and capable of withstanding financial storm. Thank you.
Hi, my name is SHRI. Today, I would like to explain about identify the nature of an internal capital adequacy assessment program in a bank. There are three subpoints below 5.3. Let's look at the first one, which is describe how capital adequacy rules apply to Islamic bank. To begin with, let's explore capital adequacy rules as they apply to Islamic banks. Islamic banks must ensure they have enough capital to cover potential risk similar to conventional banks. However, there are some key differences in the way these rules applies due to unique nature of Islamic finance. The core rule is the capital adequacy ratio, which is CAR, which compare a bank's total capital to its risk weighted assets. The Basel III framework, which governs these regulations, has been adopted for Islamic banks, reflecting the distinct nature of Islamic finance. For example, Islamic banks deals with the risk-weighted assets that are adjusted for contracts like mudarabah and musharaka, which are profit-sharing agreements. Unlike traditional interest-based lending, this contract involve risk sharing must be managed accordingly in banks' capital assessment. Overall, Islamic banks must ensure that their capital is sufficient to absorb all the types of risk while adhering strictly to Sharia principles which prohibit interest, riba, and mandate ethical investment practices. Next, 5.3.2, which is the large exposure risk requirement for Malaysian banks. This regulation is designed to prevent a bank from becoming too reliant on a single counterparty or group of counterparties. By doing so, it helps avoid excessive risk concentration. In Malaysia, banks are prohibited from having exposure exceeding 25% of their total capital to any one counterparties or group of related counterparties. This ensures that no single borrower or group can put the bank at risk in the event of default. Additionally, if a bank exposures exceed 10% of its total capital, it must seek approval from Bank Negara Malaysia, which is BNM. This process helps ensure that large exposures are carefully scrutinized to prevent any one exposures from jeopardizing the bank's financial health. To mitigate the risk, banks are encouraged to diversify their exposures, spreading their risk across different sectors, industries, and borrowers. This is a key strategy for maintaining stability and safeguarding the financial system from potential shocks. Finally, for 5.3, let's discuss the operation of savings and investment accounts in Islamic Bank. These two types of accounts are central to how Islamic banks operate and they must align with Sharia principle to ensure compliance with Islamic law. Starting with saving account, these are usually offered on a non-interest basis, meaning no riba interest is involved. Instead of interest payment, Islamic banks may offer returns based on profit sharing models where the deposits returns is linked to the performance of the bank's investment. This structure ensures that both the bank and the depositors share in the risk and rewards in the investment. Next, let's look at the investment accounts. These accounts are often based on murarabah, which is profit sharing, or musharaka, called as joint venture contracts. In these arrangements, the bank and the customer share the profits and sometimes the losses based on an agreed upon ratio. This ensures that there is a partnership between the banks and the customers in line with Islamic principle of fairness and equity. Effective risk management is essential in the operation of these accounts, and the bank must manage liquidity, market risk, and other operational risk while ensuring that the customers' funds are protected. The bank's Sharia governance framework plays a crucial role in ensuring that all investment activities remain compliant with Islamic law. In conclusion, we cover the key regulatory requirements that shape risk management in Islamic banks. From the internal capital adequacy assessment program to capital adequacy rules and large exposure risk. Additionally, we discussed the operation of savings and investment accounts, highlighting how this must align with Sharia principle. By adhering to these requirements, banks can ensure that they remain resilient, compliant, and financially stable, ultimately safeguarding both their customers and the broader financial system.
Assalamualaikum and good day to everyone. My name is Hennie Soraya. My matric number is 01DKB23F1012. In this presentation, I will be discuss about corporate governance, which is a critical part of the risk and compliance. Corporate governance play a key role in maintaining trust, ethical behavior, and stability in the financial sector, services sector, especially in Malaysia. So, what is corporate governance? It refers to the rules, practice, and process that guide how a company is directed and controlled. In simple terms, it's about making sure a company is run in responsibility, ethical, and transparent way. For financial institutions like banks, this is especially important. Good corporate governance help prevent fraud, poor management, and risky decisions that can harm the economy. It ensures that those in power, like director and executive, are accountable for their action. In Malaysia, where the financial industry play a big role in the economy, strong governance protect not only investor and customer, but also help maintain public trust and financial stability. Now, let's talk about the Malaysia Code on Corporate Governance, or MCCG. The MCCG was introduced by the Security Commission Malaysia. It provides a set of best practice to improve how companies are governed, especially public listed companies. Although it's not mandatory for all business, it acts as a strong reference for financial institutions to follow. The main goal of MCCG is to help companies adopt high standards of governance, focusing on leadership, accountability, risk management, and transparency. Now, let's take a look more details about MCCG main areas. For the first is board effectiveness. This ensures that board members are qualified, diverse, and able to lead the company properly. Second is risk management and internal control. Company should have strong system to detect and manage risk effectively. Next is corporate reporting. This means sharing accurate and timely information with stakeholders, especially financial data. Last is stakeholder engagement. Companies should communicate clearly with all parties involving, including stakeholder, and customer. So, when financial institutions follow the MCCG, they build greater public trust and show that they are committed to ethical practice. There are 5 main principles that form the foundation of good corporate governance. First is fairness. All stakeholders, such as shareholders, employees, and customers, should be treated fairly and equally. Secondly is accountability. Management and director must be held accountable for their action and decision. Next is responsibility. Every person in the organization must clearly understand their roles and duties. Next is transparency. Companies should disclose important information truthfully and in a timely manner. Last but not least, independence. Having independent board members help prevent conflict of interest and ensure objective decision. These principles guide financial institutions in making ethical, informed, and balanced decisions that contribute to their long-term success. In conclusion, corporate governance is more than just following rules. It is about building a strong culture of honesty, responsibility, and trust within the company. By applying the principle of corporate governance and following the MCCG, financial institutions in Malaysia can reduce risk, improve their performance, and gain public confidence. So, thank you for watching, and I hope you now have clear understanding of corporate governance and its importance in the financial industry.